Welcome to Macro Pulse. This week, we'll be looking at the most recent market volatility. We'll review Trump's inauguration and his first few days in the office. And we'll also be reviewing some of the most recent data points out of South Africa and China. But let's start with the recent market volatility. In previous episodes, we've discussed how 2025 will most likely be a year of disruptive policy setting, especially in the US. There's a lot of questions still about monetary policy. Inflation concerns seems to be re-emerging, and the question is whether the Fed will continue to cut rates, at what pace, and some commentators even suggest that the Fed may be close to pausing rates and that we may actually see some further rate hikes this year. So a lot of uncertainty on the monetary policy front. On the fiscal policy front, there's questions around taxes. Will we see tax cuts later this year? Will there be some government cuts, spending cuts made, and when will those happen? And then from a foreign policy side, the sustainability of the current ceasefire in the Middle East, that's questionable, as well as will we get an end to the war between Russia and Ukraine. And there's also some questions around the trade policy and whether Trump will announce trade tariffs against China and the rest of the world. So these uncertainties are creating volatility in the market. And we've seen since the end of last year how this uncertainty has driven up bond yields. Bond yields have become extremely sensitive to policy headlines as well as data points. And the rise that we see in bond yields last year, from about September, 100 basis points roughly up until now, if you compare that with the 100 basis points of cuts that a Fed has also implemented, it is unprecedented that you get Fed rate cuts, but you still see a rise in bond yields. And you may argue and ask the question, did we actually see any financial conditions easing? Now, if you look at what was causing those bond yields to be rising, or the uncertainty around fiscal policy, the concerns around inflation, and then also in December, you had Powell come out and deliver a fairly hawkish cut. In his statement and in the press conference, he did make mention that policy uncertainty is playing a role in potentially inflation risks, but also that the economy is still fairly robust and therefore they can take a little bit more caution in continuing to cut rates. And so the Fed has moved back from guiding the market towards 4 cuts to 2 cuts for 2025. This obviously will also have some implications to the SARB. Now, over the last couple of weeks, we did see an improvement in the macro backdrop. So beginning of this year, we saw bond yields still rising, US dollar was strengthening, and that has put a lot of pressure on emerging markets and other risky assets, including equities. But in the last 2 weeks, we had 2 positive macro developments that I think we need to discuss in more detail. The first one is that we had inflation prints that came out a little bit lower than the market was expected. And that obviously has again maybe faded some of the concerns that inflation was re-emerging. And so clearly that's a positive. And some of the Fed members have come out afterwards and said maybe there is scope for more rate cuts this year. The second thing was Trump's initial policies, his inauguration, the speech that he delivered there, as well as his first few days in office. The policies that we got, especially around trade tariffs, wasn't as severe as the market was feared. Now, if we just quickly talk about his inauguration and his speech and the agenda that he outlined for policy in this coming year or 2 years. First of all, his inauguration speech primarily focused around the key election issues. So he talked about securing the border, bringing inflation down, free speech, as well as protecting manufacturing. And when it comes to, first of all, securing the border, he said and he announced a national emergency on the southern border. And he said that he will deport millions of migrants and illegal migrants back to where they came from. This may have some implication to the labor market. It may tighten the labor market slightly and also be a little bit of a drag on growth. On the inflation front, he mentioned also announced a national emergency around energy production. They want to increase energy production, increase supply, and therefore drive down the price of oil to support inflation coming lower. He also announced the new Department of Government Efficiency. This department will be focusing on government efficiency, but then also cutting potential government expenditure. And so that may also bring down inflation to some extent. And on that topic, they did announce that all federal workers must return to office as soon as possible. In terms of his third policy around manufacturing, he did say that he will use tariffs, and he actually did announce an external revenue service to collect those tariffs. But he didn't make any explicit announcements around tariffs that he would impose on China. The market was fearful that he would impose on day one tariffs on China as well as on the rest of the world, and we didn't get any announcements around a 10% universal tariff either. So those two things, I think, did allay some of the fears that the market was fearful of initially. Post his inauguration, he did say, however, that he will put 25% or up to 25% tariff on Mexico and Canada on some goods by the 1st of February. He also did say that he may next month impose a 10% tariff on China. Both of these announcements has been linked to immigration or illegal immigration into the US and also some drug trafficking. So from our perspective, it confirms our view that the tariffs, to some extent, is a tool to achieve certain objectives rather than a goal in itself. And so in our view, we will see some tariffs, but those tariffs will most likely be delayed, more targeted, and it therefore potentially have an impact only later in the cycle than the market is fearful now. Other interesting things that was announced during the inauguration speech was the end to the EV mandate, as well as the Green New Deal, the fact that they want to put a US flag on Mars, the announcement to take control of the Panama Canal again, that foreign policy success will be measured by the extent to which they can stay out of wars and potentially end wars, that federal workers have to return to office, and that they will rename the Gulf of Mexico to the Gulf of America. Finally, we want to make a few points on the data that we got from China and South Africa. In terms of China, we saw better than expected data out of China. The Q4 GDP number came out at 5.4% on an annualized basis, and therefore 2024, the growth rate was 5%, which is in line with the target that the authorities have set themselves. Now, remind yourself that in Q4 last year, the authorities really started to ramp up some of the policy measures to try and support the economy and to stabilize the property market. And we are starting to see some of that coming through the data points. We also saw that industrial production has improved, retail sales are improving, and even though house prices continue to fall, they are falling at a slower pace. We even saw that the Chinese equity market outperformed the US and world equity market during the second half of last year. And so if some of these data points and market moves can continue, we may start to see the beginning of an uptick in consumer and business confidence in China that may start to support the economy. Remember, back in August 2020, authorities deliberately announced the policy, the 3 red lines, to start a process of deleveraging the economy from the property sector. And now, in the fourth quarter of last year, they deliberately announced that they want to stabilize the property sector. And we believe they won't stop bringing new measures into play to support the economy until they've achieved that result. When it comes to South Africa, we also had some good data points. Remember last year in Q3, we had the GDP number showing a contraction in the third quarter of last year. However, when we looked at the fourth quarter and we look at some of the high frequency data points, it appears as if the economy may exceed a 2% annualized number for Q4. And we believe that in 2025, the growth rate will be higher than the 1.7% that the market consensus is still expecting. So what makes us more positive still? First of all, we are seeing improvements in the network economy. In terms of rail, last year we had rail volumes grow by 4%. We also see that on the electricity front, the amount of supply increase last year was close to 7%, while demand grew about 3%. The electricity availability factor at the moment is roughly about 60% relative to last year this time when it was around 50%. So definitely an improvement in the network economy. Also improvements on the consumer front. If you look at vehicle sales, for instance, in the second half of last year relative to the second half of 2023, vehicle sales or passenger vehicle sales is up almost 9%. Real retail sales over the last year is up close to 7%. And if you look at the consumer wallet for 2025 relative to 2024, we believe we will see an improvement there as well. However, it's not all plain sailing for the consumer. There are some risks that's out there, and in particular, inflation. We have seen more recently how the rand has depreciated, which is inflationary. We've also seen how the oil prices move slightly higher, again, inflationary. And the maize price has remained high. Food prices at this stage is still fairly low, and food inflation is still fairly low, but there's typically lagged impact from a high maize price to higher food inflation. And we think that may start to run out later this year. So we need to watch the inflation side. It's therefore accepted that the SARB will remain cautious and may, as soon as this month, decide to pause interest rates. However, looking forward, we still believe that the SARB has got some scope to cut rates and cut more than the market's one cut that is expected at the moment. And therefore, we remain overall still constructive about local assets. Thank you. That's all for today. Thank you for watching.